Welcome to this presentation. I will be discussing the company Hotel Chocolat, which is a AIM listed company in the UK. As the company grows, potentially it might dual list on another stock exchange, but the important thing that I want to do is just skim over what the company does and analyze it from an economic and business perspective. Just before I go on, I am the author of 2 books, one international selling book and also a book that has just been published recently. You'll get full details at the end of the presentation. If we go on to the agenda, as I sort of alluded to at the beginning, I just want to sort of briefly give you a snapshot of what the company does and also analyze it from an economic point of view, because this is actually quite a good company and I'm going to explain why, and they should have quite a good future going forward. So at the moment they are based in 4 locations in the US, 5 in Japan, 4 locations in Denmark and 125 locations in the UK. So their main base is UK. So all UK stores are profitable, which is significant because not all chains can say that. Some of their stores are loss leading and subsidised by others in better areas. They sell their products obviously from their shops, but also they have partners that sell the products on their behalf. Interestingly, they distribute their own product through a fleet of vehicles, so they ship it up and down or track it up and down the UK by their own fleet of vehicles, and they have a phased expansion. Their operations are in Cambridgeshire and they've purchased some land next to the factory to expand it, which is obviously a very good sign. A very ambitious company. In Japan, what they've done in Japan is quite significant. They've got a store over 2 stories within Japan's biggest mall. And what I like about Japan is when I studied my master's degree in risk, one of the topics was how businesses can expand internationally. And one of them was by joint ventures and sort of maybe you could say as a turnkey. So you would partner with a joint venture, you would partner with a foreign enterprise, and it sort of mitigates your risk because you're not sinking loads of capital into this venture. If it doesn't work, you make a loss on that. You're partnering with someone else who's sort of sharing the risk. And what I like about this is Hotel Chocolat own 20% of their Japanese arm of the business, and local management own 80%, but Hotel Chocolat have an option to buy out or buy a majority share of the operation. So they've really done this they've managed their risk very well, and they can capture a lot of the upside, whereas if this whole thing didn't work, then they've mitigated the risk quite well, which is a good strategy. In the US, the first site broke even after its first year, so that's not too bad. The other important thing to note is that the company obviously has foreign exchange exposures. They hedge 18 months worth of that exposure, so they're not going to suffer from adverse movements in the pound. Obviously, with the political situation in the UK at the moment, the pound is very volatile, but it's not really going to affect earnings at the moment, not in the short term anyway. And they've got 4 Danish franchise stores, and they are opening a new Copenhagen store in Denmark as well this year in 2020. They have assets in St. Lucia. They have a hotel, a restaurant, and also a cocoa farm, which is quite important, and I'm going to get to the reason why. So this AIM listed company has assets in a few continents, and that's, I think, a very good sign. It wouldn't surprise me, depending on how Brexit unfolds, that they end up expanding more into Europe as well, possibly China, who knows. When you look at the company ownership, both founders have about 1/3 of the company, which is quite unusual because they was obviously very well funded, because a lot of founders have to give away a massive amount of equity to access finance in order to do the things that they want to do. So this is quite a good it's a good sign in my mind, because the founders are they haven't sold so much of the company equity that they don't care what happens now. They've already cashed out. And the other thing is as well, they can't have looking at the shareholding structure, they can't have any activists that tell them what to do. They've got a majority stake. If ever there's a dilemma, trilemma, whatever, they have the most votes. So no one can make them do what they don't want to do with the company. Just quickly, you can see with the bars, this is the dividend payout. So they started paying out. I think the IPO was 2016, and they started paying dividends in 2017. And the last year, the dividends wasn't increased, which isn't a great sign. But then this is an ambitious company looking to move abroad and also expand output as well. So now we start to talk about the economic analysis, and something that I quite like about this company is they are a chocolate producer. So if the price of cocoa goes up, unless they can pass that on to customers through their prices, then they have an exposure to cocoa prices. And what I like is that they have a natural hedge. Now, there's a few ways that if I was to open my own version of Hotel Chocolat, there's a few ways that I could manage cocoa price risk. I could buy a forward contract and lock in a price for delivery in a different time period, or I could go long the futures market, or something else. What you can do is called a natural hedge. And this is something that Delta Airlines done. Delta Airlines, obviously, they have jet fuel price risk. If the price of oil goes up, then their costs go up. So they bought an oil refinery. So if the price of oil goes up, part of their business is offsetting the other part, if that makes sense. So if we bring it back to Hotel Chocolat, their natural hedge is that they grow their own cocoa. So if the price of cocoa goes up, the revenues from their cocoa plant in St. Lucia will offset some of the price increase from purchasing from West Africa. And as you can see here, the value of the St. Lucian cocoa will go up. The cost of other cocoa imports will go down. But something that's quite significant here is minus basis risk, because cocoa prices could go up because of adverse weather in the Caribbean or Central America or something like that. So cocoa prices might go up because of supply issues, but they might not be able to sell at these higher prices if it's something local to the Caribbean that's causing the supply outage. So that's one thing to bear in mind. There is basis risk. This natural hedge is not perfect, but it's better than a lot of cocoa producers have probably got. Sorry, not cocoa producers, cocoa companies. Something that the business analysts might want to know about this is something called asymmetric dominance effect. And this is something that I wrote about in my book. And what this does is that there's been a few studies that have confirmed this. You can make consumers switch from one product to another. So if I want to sell an upmarket product, what I do is I put a really highly priced product in my store or on my website, and it makes my premium product look more affordable. And like I say, there's been a lot of studies that have discussed this, and there's a psychological thing where there's what's it called? I can't remember what it's called now. Oh, my mind's gone blank. It's an extremeness aversion. So customers, when faced with uncertainty, if they've never purchased a product before, and there's a low price product, a medium price product, and a very high price product, studies suggest they typically go for the middle. And what you can do, if you want to sell, as I've put on a point here, if you want to sell a lot of £50 chocolate hampers, the way to do that is to put a chocolate hamper for £160, as Hotel Chocolat have done, because then customers will go, oh, £50 is a lot to spend on the hamper. But if they've got a range between £100 and £160 for a hamper, then they might think, oh, perhaps I will go for the £50 hamper. So even if Hotel Chocolat don't sell many of these £160 hampers, it doesn't really matter. It's there to provide a contrast. And that's a very good strategy that they've used, bringing in very high priced products to make their other high priced products look more affordable. And economies of scale, They have a phased expansion over the next year or two. They've purchased land next to their factory. They will be expanding and increasing production by about 30%, which means that they can sell more volume. They have purchasing power. It will drive down costs because of economies of scale. It will drive down costs. So what I expect is that they will be able to grow quicker. They will have better costs. And they could even, if they wanted, they could bring the price of their product down so it's more competitive and still maintain their profit margin. And the barrier to entry is the thing, I won't go into too much detail, but the cocoa market is very fractured. There's a lot of small farmers that add to supply, global supply. And you've got these massive enterprises like Cadbury and Nestle, and they've got massive buying power. You could, where you're so big, you can go to suppliers and say, we're going to pay you a percentage below the world price for cocoa, the futures price. And if you want to fill that void and sell all of your cocoa at that price, maybe you take it. And this is something that Hotel Chocolat will be able to do as they start to expand output. They can basically, they've got a bit more buying pressure, so they can say, look, if you can sell to us at X price, then we'll take all your cocoa off you. If you can't, we'll go elsewhere. And that's the thing that you get with buying power. And it's a barrier to entry because if I was to start my own cocoa business, I wouldn't be able to do that. And there's something again in my book called the waterbed effect. And that's something that's quite significant here. A caveat being that Hotel Chocolat, in their reports, they say that they pay in excess of the futures price for cocoa, but they don't actually say how much, which I think is a bit, I don't know, they're very vague, and I think that's done for a reason. So I think it's to protect their reputation. There's been a lot in the press about fair trade cocoa and child farmers and things like that, and Hotel Chocolat has sort of said, well, we pay in excess of what everyone else is, but no one actually knows how much. I mean, 5%, 1%, 0.5%, who knows? And branding. The thing that I like about Hotel Chocolat is that they've done very well. They are like an affordable luxury, and even in a recession, people are stressed out. They still want to treat themselves, but they might not treat themselves buying a designer handbag or a designer coat. So those sorts of businesses don't do well in recessions. But would a chocolate company do well? I mean, you can treat yourself for about £5. You can buy a nice bit of chocolate for £5. So it's an affordable luxury. And a lot of the customers are probably quite price inelastic. They'll pay a higher price because they want the quality and they can afford the quality. So I think that they're obviously selling at the top of the value chain. So this is, again, a very good sign. They're highly innovative as well. They've got cocoa-infused alcoholic drinks. They've also come out with something called the Velvetizer, which is currently loss leading, but what they expect to do is they expect to make back that margin on the, so once you buy the Velvetizer, you buy the cocoa pouches, and they expect to make their money back there, because obviously once a customer's made an investment on the Velvetizer, they want to keep using it, which means purchasing things that make the margin back for Hotel Chocolat. The wholesale partnerships I've already sort of touched upon. So basically they give a certain amount to, I don't know, companies like John Lewis or Marks and Spencer's. I don't know the actual names, and then customers that go in Marks and Spencer's can purchase Hotel Chocolat products, but they have less than 10%. So each partner, let's say Marks and Spencer's, they only have a maximum of 10% of the range. So if you really want to go in and you want to buy, you want to browse as much as you can because you want to buy a gift, you'll have to go into a Hotel Chocolat store. You won't be able to buy the full range elsewhere, which is quite good because it ensures footfall to the actual shops themselves. And as I discussed, if you want to read any of the books that I've published before, I've studied economics and maths. I've been an investor for over 10 years now, and done a master's degree in risk. I've had online businesses and things, so I feel like quite well equipped to sort of pass on my knowledge, and this is what I've done with the book, so you can check those out. The quickest and cheapest way of getting them is on Amazon. Appreciate your time, hope you enjoyed the presentation.